Yo, everybody. Thursday, July 17th. I'm telling you, man, Florida's crazy, man. We just had, these summer afternoon thunderstorms. Man, they are intense. We just had one. Lightning, rain coming down so heavy, I couldn't even see out my window. Lost power 3 times briefly in an EMP. I think these are lightning-driven electromagnetic pulse. They shut down the electricity in my house, but then it comes right back on again. Crazy down here, man. But at least we haven't had a hurricane so far, so that's good. So I was gonna do a video last night, but I came back a little bit late from boxing and I wanted to have dinner. By the way, there's nothing like, let me just say this, man, my sparring sessions, fight sports, let me just say fight sports, I do boxing, and specifically I'm talking about sparring, where you're getting into a ring and you're getting punched and you're punching people. That is the best therapy, I think, of anything. Like, forget about going to counseling, forget about seeing a shrink, forget about, watching motivational videos. If you're feeling down, if you're in a funk, anything, cobwebs in your head, get in a boxing ring and slug it out with somebody. I think it should be a requirement that all people should have to go and spar once or twice a week. I think if that was mandated, then we'd have a much nicer society. I really do. I think people would be calmer. I think they would be more polite, better behaved. It's the best. All right, anyway, let's talk about what's going on in the market. So, I told you, the flows are really strong. We're gonna go up. I don't see anything in the sentiment surveys, the sentiment data that would indicate any kind of extreme bullishness. As a matter of fact, in the most recent AAII survey, bearish sentiment went up. So now it's I think it's 22% or something like that over the historical average. So what happened in that survey in the last week, and that's the week ending yesterday, the 16th, you had the neutrals jump into the bearish camp. So bullish sentiment came down, bearish sentiment went up. I haven't checked the put-call ratio, but that hasn't been really, really low. It's a little bit low, but it's not at an extreme low. So I just think the market sentiment combined with the flows, this thing is going to keep going up. And now we had the increase in the debt ceiling, so normal treasury operations are going to start, I think, next week. Start selling, start draining out some of these reserves. Banking data has been really good. Loan growth, bank capital, all this stuff. So I don't see any problems right now. I still would say, let's see what happens after the August 1st tariff situation, if Trump sticks with that. But as I've been telling you guys, we also have a quarterly interest payment in August 15th. And so that could wash out any or a lot of the negative effect from the tariffs, at least in August. So we might have to look to September. And again, I said, I think in September or the end of September, beginning of October, that's when those Doge government worker salaries end. So that could be a thing. But right now, there's nothing in the path here. You're going to get your regular headline trading back and forth, but that's just handing you money on a silver platter. If you get one of these negative headlines, like Trump says something about the tariffs and it dips down, you buy it. It's easy money right now. Easy money. So I've been reading about this stuff, people commenting on I mean, this is again back, back in the discussion. It seems to pop up every now and then, just like the inverted yield curve. Remember, I mean, like, how many times have we been through that? And I debunked that whole thing. But now it's yield curve control. They even have an abbreviation, YCC. They don't even write it out. They just write YCC. So, like, the way it's talked about, it's like this is some kind of new thing, right? Like, oh, the Fed might engage in yield curve control. So it makes me laugh because the very existence of the Fed and its monopoly to set interest rates, that right there, that in itself is yield curve control. This is not a new thing. I mean, the very fact that the Fed has a monopoly on rate setting, that's yield curve control. Because what is the yield curve? The yield curve is a reflection of Fed policy over the term. What does that mean? It means, like, as you go out over the curve, 2-year, 5-year, 10-year, 20-year, 30-year, those maturities are going to reflect the expectation of monetary policy over that period. So, like, right now, for example, when the Fed keeps saying, oh, we're going to hold rates where they are, 4.25 to 4.5, like, the 30-year is not going to deviate very much from that 4.5 upper bound. I mean, yeah, it could go to 5%, just like we saw the 10-year, what was it, back in March, it went to like 360. Sometimes recently now it's dropped down to 414, but then it bounces right back up into that 4.25, 4.5 range. And like I said in my last video, if the Fed came out tomorrow and said, we're going to set rates permanently at 0, the whole entire curve would drop to 0. The Fed wouldn't even have to do anything because everybody would be jumping ahead of that, knowing that the Fed has the power to do that. So they would be buying securities to lock in whatever positive rate there is right now, and it would push the whole curve down to 0. So this thing, when you see these people talking about, oh, yield curve control, oh my God, like, this is another one of these things, like what, QE, or the Fed's gonna reduce its balance sheet. People don't understand. I mean, they make a big thing out of all this. If you understand what's going on, like when the Fed reduces its balance sheet, what does that mean? It just means that it is allowing securities to remain in the economy, so the economy benefits as a result of, those are securities that the Fed would have owned itself, would have bought. It's allowing those securities. So all that is just a recomposition of financial assets in the economy. All right? The economy has more government securities and less reserves. That's it. The financial balances, look, here's an easy way to think about it. Let's say you have $10 million in cash and I have $10 million in bonds, in treasury securities. And I say, hey, let's swap. I'll give you my 10 million in, did I say 2 million? 10 million, 10 million. You have 10 million in cash. I have 10 million in treasuries. And we swap. I give you my 10 million in treasuries. You give me your 10 million in cash. Our financial position, mine and yours, hasn't changed at all. We're still worth 10 million, all else equal. And actually, you probably come out ahead in that situation because now you own securities that earn interest. I'm sitting on cash. That's it. That's what it entails. So every time the Fed does this, the only thing it's doing is redistributing the financial assets in the economy. Not redistribution, a recomposition of the financial assets in the economy, at least, part of the financial assets. People get all worked up about this, man. It's nothing. It's really nothing. That's how come every time this stuff happens, what do I say to you guys? I say, we're going to come back and we're going to revisit this, 6 months, 9 months, a year down the road. And everything I'm telling you right now is going to end up the way it is. And that's exactly what happened. I told you that in 2022 when he started raising interest rates. And I said, look, it's going to create a boom. The stock market's going to go to new highs because it's just a fiscal operation. Transfers of interest, income to the economy. The same thing when everybody was panicking. They said, oh, the Fed's going to start reducing its balance sheet. The Fed went from like almost 10 trillion. When was that? Like in 2022 or something, when it was up like 9.8 trillion. Now it's like 6 trillion. So like a 3 trillion drop in its balance sheet. What happened? Nothing. The economy's still growing. The stock market's at a record high. I mean, you got to understand what this stuff is. If you like I always say, knowledge is power, all right? Here's another thing that is fascinating to me. Like in 1978, Congress passed the Humphrey-Hawkins Act, which Jimmy Carter signed into law. Now, the Humphrey-Hawkins Act mandated the federal government and the Fed to do certain things. Like the federal government had to kind of manage the economy. It said full employment, I think, run a balanced budget, run a trade surplus, stuff like that. The other two, the latter two, we're not doing, all right? But it also said in there that the Fed has to take care of full employment, low inflation, and price stability. Now the Fed, it doesn't have the tools for this. All the Fed does is basically, like I said, it could change the composition of financial assets in the economy. It could set rates. I mean, that is not, those are not the tools to create jobs. And by the way, this whole rate setting thing, how is that price stability? I mean, 1 minute the rates are at 0. The next minute the rates are at 6.5. The next minute the rates are at 4.5. The next minute the rates are at 3.5. I mean, this bouncing around in interest rates is the thing that creates instability. Like if you run a business and you want to try to plan, what's my inventory gonna be? What are my loan payments gonna look like? All this kind of stuff. And then the rates are bouncing around every year all over the place. It makes it impossible. Like that's not price stability. This Humphrey-Hawkins thing, that's got to be one of the dumbest pieces of legislation that Congress ever passed. I get it. The intent was, hey, let's manage a good economy where people have opportunity. They're getting paid well. They got jobs. Inflation is, I get it. The intent behind it, it might have been noble and good. But basically what happened, in my opinion, is that Congress just kind of handed it off to the Fed. And the Fed has no tools for this. Imagine you're running a business, a very complex business, which like you could think of that as the U.S. economy. You're running a business, a very complex business, lots of employees, lots of moving parts. And you go to the bank, you go to JP Morgan Chase or whatever, and you say, I want you to manage our business. Make sure it runs just efficiently and perfectly. What can you do for me? And JP Morgan Chase says, Jamie Dimon says, we could make loans against collateral. And you're like, great. What else can you do? Well, that's it. And you're like, what do you mean that's it? I got supply chains. I got a trucking fleet, I got employees, I got, production facilities, I got this, I got that, I got insurance I got to deal with that. That's it? You can lend against collateral. Yeah, that's basically what we're talking about here. So Congress says to the Fed, we want you to manage the economy. And the Fed's like, yeah, okay. How? By making loans against collateral? Or by setting prices? And by the way, banks could set prices because on the rate they set on loans. Okay, not everybody's loan is the same rate. Depends on your credit and all this other stuff. And the loan rate, the rate you got to pay on your loan, that monthly payment or whatever it is, semi-annual payment, whatever it is, that's going to affect how you price your goods and services as a business. So are the banks, they're rate setters too. So what is this? I mean, what are we doing here? What are we doing here? But the real question is why are people so fixated on this stuff? If you really see it the way it is, as I've explained it to you, then all this fixation, and I'm not saying necessarily you guys, but I mean, the media, the financial community, economists, analysts, I mean, if you step back and if you look at the way they talk about this stuff, the kind of importance they put on this stuff, and really the fact that their understanding is so wrong, it's kind of mind-blowing, because these people are taken very, very seriously. I don't have to tell you, they're taking it, they parade them out on CNBC and Fox Business, and there's articles written and people quoted and blah, 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 all this stuff, and everybody's just, they're on the edge of their chair, listening to these people when they don't know what the hell they're talking about, and they live in this bubble, in this world of their own kind of made-up information. And they see everything through the prism of that made-up information. But again, I mean, this is a theme. I guess I've been harping too long on this theme. It's just it creates opportunity for us. If you have patience and you see this stuff going on, it's good. I mean, take advantage of it. Take advantage of it. That's what I think, anyway. Anyway, it's real quiet now. That's the other thing about these Florida storms, man. I mean, they come through like this mighty tempest, and then it's dead calm after that. And what I usually get out here is a symphony of frogs. For some reason, that wakes them all up. And I mean, sometimes the sound of the frogs croaking, it's deafening, which is crazy. I got coyotes running around here. I got all kinds of stuff. Anyway, that's it for today, folks. Please like and subscribe. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.